Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Warner Brothers Discovery stock so we can determine if it's a buy or a sell. Warner Brothers Discovery is a mass media and entertainment company. It was formed after the spin-off of Warner Media by AT&T and its merger with Discovery last April. It owns and operates Warner Brothers Film and Television Studios, comic book publisher DC Entertainment, HBO, Discovery, Scripps Network, Turner Broadcasting, CNN, Discovery Plus Streaming, and much more. The company is headquartered in New York, New York, and was founded in 2022. Let's get started with the model. This is a large cap company, 29 billion market cap. They're trading at $12 a share, and they have 2.4 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow is pretty consistent year to year. It peaks in 2022 at 3.3 billion, down to 2.1 billion in the trailing 12 months. Net income is a profit or loss on the income statement. It's revenue minus expenses. That's positive in 2020 and 2021. Lots of write-downs in 2022, so they have a big negative. Even more so in the trailing 12 months at negative 9 billion. Revenue is a sales for the company, and when it was just Discovery, it was 10.6 billion, then 12 billion. Now with Warner Brothers, it's gone up a lot. 34 billion up to 41 billion. Here's their most recent income statement, the first quarter of 2023 versus the first quarter of 2022. Revenue for the first quarter was 10.7 billion, up a lot from last year because it was just Discovery last year, 3.2 billion. Distribution revenue 5.2 billion, advertising 2.3 billion, content 3 billion, and other 300 million. Let me give you a further breakdown of their revenue. Of the 5.2 billion of distribution, 3 billion is from networks, 2.2 billion direct to customer. Networks refers to the television networks in the US and outside the US. DTC is direct to customer streaming. Most advertising revenue is from the network category, when companies pay for advertising space, the commercials. Most of the 3 billion of content comes from their studios. When you hear studios, that's the production and release of feature films, also licensing of its TV shows. Of the 10.7 billion of revenue, 3 billion is in studios, 5.6 billion in networks, 2.5 billion from streaming. If you're not sure what distribution is, or advertising or content or other, let me give you a little more color on that. Distribution revenues are fees charged to network distributors. That includes cable, direct-to-home satellite, digital service providers, and streaming subscribers. Distribution revenues are really dependent on the number of subscribers and, of course, the content. Their distribution decreased 2% in the first quarter of 2023 from declines in streaming wholesale revenues and linear subscribers. When you hear linear, that's traditional television, the type of television we've been watching for decades. And this was partially offset by international streaming subscriber gains. Advertising is mainly from commercials on regular TV and digital platforms. And that decreased 14% compared to last year, mainly due to the declines in US general entertainment and news networks. This was partially offset by strong advertising for the March Madness tournament. Content revenues are from the release of feature films. It's also the licensing of those films and television programs. Content revenue decreased 5% this quarter compared to last quarter, and that's due to lower TV licensing and theatrical film rental revenues. And that's partially offset by higher game revenues due to the release of Hogwarts Legacy. Other revenues is studio production services and tours. That increased 37% year over year. Here's a breakdown of their cost and expenses. Cost of revenue 6.7 billion, SG&A 2.4 billion, depreciation and amortization 2.1 billion, 95 million restructuring, 31 million of impairments. So total cost and expenses 11.3 billion. I'll give you a little more color on what this is. Cost of revenue is mostly content expense. The content includes television, films, games, and sporting events. Cost of revenue increased 4%. SG&A is payroll, marketing costs, research costs, occupancy, and back office support fees. That decreased 28% due to lower marketing expenses. Depreciation and amortization increased 6%. That's mainly from intangible assets from the merger with AT&T. Restructuring is from the merger, the Warner Bros. Discovery merger, and that increased $90 million. And that's from contract terminations, facility consolidation activities, and organizational structuring. When you take their revenue minus their expenses, they have an operating loss of $557 million. Last year, they had a gain of $353 million. The company has a lot more debt now with Warner Brothers. They paid $571 million of interest on their debt. A loss before taxes of $1.2 billion. A tax benefit of $178 million. A net loss of $1.1 billion. Last year, they had a net gain of $500 million. So their loss per share is 44 cents. Last year, they had a gain of 69 cents. And now they have a lot more shares outstanding, 2.4 billion. Last year was 600 million. Let's look at their operating cash flows. And the way you calculate operating cash flow, you start with your net loss, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we start with the net loss of 1.1 billion. We add back content amortization of 4.7 billion. Depreciation and amortization of $2.1 billion. They pass through a gain of $669 million of deferred income taxes, so we minus that out here. Deferred income taxes are taxes a company will eventually pay but are not due yet, so it's deferred into the future. They had a cash outflow of $4.1 billion from film and television content rights. That's a big expense for this company, content, it's so expensive. And they had a cash outflow of $1.65 billion in accounts payable. So this means they bought a lot of items on credit in the past and are paying for it now in this accounting period. So even though they had an accounting loss of $1.1 billion, their cash outflow was $630 million. This was in Warner Bros. Discovery 10Q. It explains the merger with Warner Bros. On April 8th, 2022, Discovery completed its merger with Warner Media. On April 11th, 2022, the shares traded on the NASDAQ under ticker WBD. The merger was executed through a reverse Morris Trust type transaction, under which the new company was distributed to AT&T shareholders via a pro rata distribution, and then combined with Discovery. I added this blurb down here so I could explain what a reverse Morris Trust is. It's a tax strategy where a company spins off and then sells assets. And this way it avoids paying taxes on the gains from the disposal. In order to form a reverse Morris Trust, the parent company must spin off a subsidiary or other unwanted asset into a separate company, which is then merged with a firm that is interested in acquiring the asset. Discovery was interested in acquiring the asset. After the RMT is formed, stockholders of the original company own at least 50% of the value of the combined entity. AT&T shareholders own 71% of Warner Bros. Discovery. Let's go back to the info from the 10Q. Prior to the merger, Warner Media distributed $40.5 billion to AT&T, and that was a combination of cash, debt securities, and retention of certain debt. Discovery transferred $42 billion in equity to AT&T shareholders. In August 2022, the new entity and AT&T finalized the post-closing working capital settlement process, and that resulted in AT&T providing the new company $1.2 billion. That was in the third quarter of 2022. That was in lieu of adjusting the equity issued as purchase consideration in the merger. When the new entity was created, AT&T shareholders received 71% of the common stock of WBD, and Discovery shareholders received 29%. Let's look at the capital structure. $46 billion of equity, $49 billion of debt. They're 49% equity, 51% debt. Their net debt is $46 billion. So that means they have about $2.5 billion of cash on their balance sheet. They have a pretty high WACC, 12%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows, past year 4, that's $41 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $38 billion. We divide that by 2.4 billion shares. And we get a calculated stock price of $15.45. They're trading at $11.75, so they're trading at a 24% discount. It's a buy according to the model. Simply Wall Street is even higher than me. They're at $26. They say the stock is 54% undervalued. 10 analysts price this stock, and the average price target is 21, the lowest 14, the highest 36. Another 24 analysts price this stock, and the average price target is 21. They say the stock is 79% undervalued. This is where the stock has been trading since 2005. Its lowest point was right after the Great Recession. It looks like it got as low as $1 or $2. Imagine getting it for that price. And then over the next 5 years, it ran up past 40. That was in 2013, but the stock struggled for the next 7 years, falling below $20 right after COVID hit. Then there was an investor named Bill Wong, and he was buying total return swaps and using lots of leverage to pump up the stock price. That's why the price got so high, close to $80. Then he defaulted on those swaps, and the stock came crashing down. Even after that big decline, the stock kept coming down even more. It looks like it fell below $10 at the very end of 2022. It has come up since then, but it's not trading that much higher than what it was at IPO. There are 40 companies in the same industry as WBD, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, $1.2 billion. These are investments in property, plant, and equipment. Their debt to equity ratio is equal to the median. They generate the second most free cash flow, second to Netflix. They rank 4th in market cap. They have a really good price to book, 0.6. We can't look at their PE since they have negative earnings. They have a really good price to free cash flow and price to sales. They generate the second most revenue on this list. And the reason their 5-year annual revenue growth rate is so high is because of Warner Brothers. So their revenue is so much higher now than in prior years when they only had Discovery. So to summarize, I have them trading at a 24% discount. They've been around for only 1 year as the combined entity. And the stock is still priced as if the company is not going to do that well in the future. They do have a lot more debt now than they did before when they didn't have Warner Brothers. But Warner Brothers brings in a ton more revenue and a lot more content. So hopefully they could take advantage of that. I rank their free cash flows 5 out of 10, their revenue 8 out of 10, and their ratio 6 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you want to become a member, you can click on the link in the description below. Thanks for watching.